Morning, friends. This is Coach Ernie, and this is the Zero DTE Morning Market Analysis. Thank you very much for joining me today. Today is Fed Day. That's a periodic day. Comes about, I think, 10 times a year, 8 times. I'll have to look at that up with the exact number of times it happens. But they skip some months here and there. And they make rate cut decisions or just rate decisions. And this morning, the market is kind of waking up a little bit tense as the VIX was breaching around 21 just hours before the latest FOMC decision, which will be at 2 o'clock today. And there's also some fresh jobless claims that we have to look forward to this morning. Now, with risk swirling around every macro headline, today isn't about making a big directional bet. It's about seeing where stress, opportunity, and hidden convexity collide. I've talked about convexity quite a bit. As you know, we're zero DTE traders, which is a subset of being a tail risk trader, which means that we're looking for asymmetric trade setups in various lengths of time. Zero DTE obviously being day trading. And then we look at tail trades in from 3 to 5, 5 to 10, 10 to 30, and so forth. And what I mean by tail risk trading is that we're looking for those big moves. And then all the small moves or the noise we essentially ignore. And the way we ignore it is we set up our trades in an asymmetric fashion so that we're not really interested in those small moves because the risk is so small that we can ignore it. And so we're trying to capture only those big moves, which is almost the opposite of what everybody else does, where they're trying to capture, small little profits by putting up big risk, right? And then they're eventually going to hit that risk, where we are not trying to capture those small little profits. We're trying to capture the big profits with very small risk. See, big difference there. So, as I said, with risk swirling around every macro headline, today isn't about making a big directional bet. It's about seeing where stress, opportunity, and the convexity is, and where they collide. We're holding up a mirror on tail risk, structural. Why can't I say that word? Structural edges. Structural edges. My mouth doesn't go that way. And the smallest asymmetric moves. Don't chase the noise. Hunt the optionality. Let's get into the thick of it. So it's June 18th. Markets are a double macro event horizon. The FOMC rate decision will define the tone for all risk assets, while the morning unemployment claims data offers a read on the real economy's pulse. And with the VIX at 21.5 or so, that signals that optionality and fear are being repriced upwards. So we've been down a little bit below that, sort of skating on zombie land, trying to get out of Goldilocks, but now we're moving back up into the Goldilocks zone. So risk coming or increasing and VIX coming up is not a bad thing for us. In fact, it's kind of great. We love the VIX up in this area. Although the past week or so, the market hasn't been really behaving like the VIX is slightly elevated at all. It's just been going kind of sideways. Sideways and then slightly grinding up. You'll see when I show you the chart. So they're all being so volatility is back in play. We just need price action to sort of confirm that. And both the structural bears and tactical bulls are hunting edge around these releases. But as I said, recent price action as seen in our volume profile screenshots, as you'll see soon, as you'll see. That's another bet. Take note of that. Those certain words I can't say, so you just all right? Thank you. So recent price action is, as seen in our volume profile, shows compression near key node edges with little conviction in either direction. A classic setup for a convexity break. And what that really means is that we're hanging out at the edge of a node. We're, trying to bump, trying to get through. And that's where convexity lies. Convexity is, and I keep on saying it, but I'll remind you, convexity is that point where everything is kind of going this way, and then all of a sudden it goes like this, right? That point, right there, right? That's convexity. So with the FOMC, uncertainty is running high. This is a regime where tail risk is no longer theoretical, it's being actively hedged. So most people aren't thinking about tail risk trades. As a matter of fact, they're trying to avoid it. And then they complain that they can't get those big trades where that's where it lies. That's where it is. How can you get it if you ignore it? And they're ignoring it because they feel comfortable with these high win rate strategies, which are really the death knell to almost all day traders and swing traders and traders in general. They think that volatility is the enemy when in fact it is your friend, right? And they're willing to get that dopamine drip of small wins and take those big risks thinking that they're never going to hit that. Oh, they can control it with their risk strategies and they're controlling their emotions and all this other crap. Of course, you know as well as I do, that doesn't work. Yeah, you might have a couple of good runs here and there, but eventually it all comes to a head. And that risk monster is going to grab you right by the cojones. And you'll never really achieve any kind of consistency ever. I know, I was in that trap for many years. I'd have fantastic runs and I thought I was a genius, and then come down, I had all kinds of excuses why. I just needed to get back to the genius part. All right? And after a while, it becomes very apparent that you don't know what the hell you're doing. And maybe it just takes more practice or whatever. I don't know the right strategy is the big one that I hear a lot. I mean, that's true. Having the right strategy is important so that you can put yourself into a position where you're not experiencing those huge risk events and that you're only going after. But see, it takes a complete flip in your mentality. So anyways, I got off into a little bit of a rant there. Anyways, uncertainty is kind of running high with this in this regime where tail risk is no longer theoretical. It is being actively hedged. I said that already, didn't I? But I had to come back to it. The core narrative is uncertainty, optionality, and the risk of outsized moves regardless of the Fed's script. Because we all know that the Fed really is they're resisting this idea of rate cuts. And not because they know better. I think it's more of a political thing, to tell you the truth. It's mostly because they have no idea. So it's better not to do anything, right? Don't do anything, then they can't blame us. Of course, ultimately, it'll be because they didn't do anything that everyone will blame them. So they're definitely in a no-lose or no-win situation. But that doesn't excuse them for their malfeasance. Why we have the Fed in the first place is really a mystery to me. Well, it's not a mystery in that if you understand human nature, the reason why we have the Fed is because we believe that we can control our destinies, that we can control something as complex as the market or the weather. Maybe someday we can. I don't know. But we're pretty feeble these days. And when we try to look at these huge systems that have really no beginning or end, and trying to think that we can control them or exert any kind of control, we realize that our tools are totally ineffective, and the only real tool is manipulating people's psyche, and that all comes from narrative. So everything that the Fed does is not about using their tools to actually control the market. It's the narrative that surrounds that. And then what they're planning to do in the future. And the entire market is 100% tied into that. That's what moves the market. What people think that they're going to do. And, the market just wants cheap money so that they can buy stuff. And so if they think it's getting cheaper, then they're going to act excited. If they think it's going to get more expensive, then they go boo-hoo. All right, getting off into the rants again. So why don't we do this? Let's get over to the charts, and we'll take a look at what's going on there. And so off to the charts. All right. This is overnight activity right now. You can see that we kind of blasted off in the early morning and then stalled and then just gave it all up. And overnight came down pretty low. And then right around when just before the Asian session is opening, for some reason we had a reprise. And it kept on rallying throughout the night until we got to this morning at around 5 a.m. And then we just dumped it all. I don't know. Profit takers? Who knows? But that has since rallied. When I first started looking at the analysis, I thought, kind of a downer. But we're moving up now. And ultimately, we went nowhere. Right? So this is the morning session here outlined in these vertical blue lines. So I'm looking for... Okay, let's get to where we're at. For 0 DTE trades, this is our playbook. We're still in that 25 to 35 range. Butterflies will probably be near 20 today. I haven't looked at it. Probably don't have to. Let's check anyways. So just give me a second here, and I'll log in and see where we're at with the big ass fly to see whether or not there is a big ass fly trade this morning. And just take me a second. Keep on looking at the VIX chart. Take it all in. That's our playbook. That's telling us what width that we're going to play our 0 DTE trades. And I'm almost set up. I'll just keep on talking. We're almost there. Come on. My fingers aren't working. All right, so we're getting close. And so, cool. All right, there we are. All right, so now I'll move to our Think a Swim so we can take a look at that. There we go. And so we'll put on a big ass fly, which is a 50 wide fly. Why do I put on a big ass fly? Because it's an effective way when you're looking at a butterfly just to look at its cost, its risk. It is 100% sensitive to morning implied volatility. And so when there's big, huge debit in that fly, that means volatility is low, because of the accelerated premium decay, and there's more risk and less potential for that day. When volatility is very high, it flattens out gamma, and then the risk goes way down, and then that means that the premium decay has delayed, and so there's much more potential. So it's kind of opposite, right? But it's really a good indicator, and that's why I use it. So anyways, I'm going to create one of those and show you what I mean. And we use 50 because 40 isn't as sensitive, and 60 and above, you start getting diminished returns. 50 seems to be, for this size of an index, the perfect thing. On the NDX, you could do a similar thing, but it would have to be about 3.5 times bigger or 3 times bigger. So you have to look at a 150 wide fly at the money. All right, so 49. We have to go to 50 wide, and then 50 wide on this side. There we go. Oh yeah. See, yesterday we were at 23, and today we're 8 points lower. 8 points. One day. What the hell's going on there? So in other words, when I say 23 and 8 points, what am I talking about? All right. So first of all, I have to make sure that I'm not on the continuous contract, which is just the /ES. I need to be on the June contract because that's where we're still living. That until tomorrow, That's what we're trading. We're trading the June contract with 0 DTE trades. There are no September contracts for 0 DTE. And so we have to see how this is appropriately sized up here. All right. So here we go. Now we need to just adjust that. There we go. So this is what I'm talking about in terms of the IV indicator. It's the debit that is going to tell us where IV is currently at. And when the debit is small, that means IV is big. When the debit is big, that means IV is small. Now yesterday, it was the debit was at 23.24, which meant it was way up here, right? Way up there. Now there's less debit. That means that volatility is heightened. And the reason why it's heightened is because of the anticipation of the FOMC minutes later today. And so you can see how a butterfly like this, you think, oh, well, what is the butterfly? How does that tell me what's actually happening? It gives you a temperature of exactly what, oh, there's a bunny right outside my door. That's unusual. You don't see that too often because of all the coyotes and everything here. I'm sorry. A little bit of ADD there. So higher volatility delays premium decay, and that creates a situation where there's more potential in your butterfly and less risk. Gamma is flattened. In other words, the profit curve is much flatter and wider. So high volatility from a options traders or a butterfly trader's point of view is really cool because it gives you more opportunity, less risk, and that's why we like it. When volatility drops, this profit curve ends up way up here, and there's less potential for that day to make money on that butterfly, and there's way more risk. Gamma starts getting steeper. That's sensitivity to price, and nobody likes that. So now you see why volatility or options traders, particularly on 0 DTE, love volatility, except for all those people that are trading it wrong. They think volatility is the death knell, when from an options trader point of view, volatility is everything. Love volatility! All right. So when we see a debit that is down around 17, we go back to our playbook, our VIX playbook, which I'm about to do right there. And you can see very clearly up here, up top, see this is the big ass fly, debit price, butterfly with guide range. So we have over here on the left, we're showing the width, but it's always in a range. And then the big ass fly tells us which end of the range to play. And when there's a lower number, we look at wider flies. When there's a higher number, we look at narrower flies. Because high means lower volatility, more gamma, more risk. So we shrink our flies to compensate for that. When there's higher volatility, there's less gamma, more potential profit in there, less risk. We go wider. It's like an anti-fragile strategy. When there's more tension, more fire, we run into the fire because we get stronger. That's what it's saying. That's really cool, isn't it? So we're looking at big ass flies way over here on the scale up top here, right there. Let me scale. It's like right there. So we're definitely on the wider side. So we'll be looking at 30, 35 wide butterflies today. Now let's take a look at the market direction. Yesterday I would have said we're bullish, but we ended up bearish. Today I'm going to say we're bearish and we're going to end up bullish. I still think that we're bullish, even though we're kind of riding the wave here. We're moving up. We're grinding up. This is what I was talking about earlier. We've been just grinding up. No breakouts. And I think it's really all coming down to today. It's really, we're grinding because the market's afraid to do anything until they hear what the Fed's going to do. because the Fed has been saying, we're not going to do anything. And then all of a sudden there's some cracks in their narrative and saying, we might do something. And then they say, we're not going to do anything. And of course, if you went and look at the Fed Watch tool, it shows definitively that they're not going to do anything, but they're still, prepping for a surprise. Even though the watch tool and the Fed fund rate and the Fed futures are saying, Fed ain't doing nada, right? So that's where we're at. So I'm going to keep it as a directional bias of bullish, right? And look at this. We're almost at that golden cross. Almost. Then what will happen? Then everyone will say, okay, we're bullish. Let's go. And then what will happen? The market will drop. Just as they get a golden cross. I'm just being a little cynical there. All right, let's look at our setup today. This is the market structure. We're sitting right on top of this node. This is the top of a node. This is the very last node. This is down here is step 2. Up here between the green and the red is step 3 of the stairway to heaven. What am I talking about? I'm talking about these 1, 2, 3. This is step 3 right up here. This is step 2. And then once we break out of there, if we can break out, look, we've already tried twice and failed. Just get rejected. So we're going to give it another shot. And then if we can, then we'll break to all-time highs. Yeah, that's the plan. But in the meantime, we're kind of just grinding, slowly upwards. Really, really tough to take. Yeah. All right. And a lot of these moves, these big candles that you see here, actually are happening overnight. And this is the futures. That's why you can see the big candles. If you go and look at the SPX, you'll see, hey, where are all those big candles on the SPX? Let's see it. All right. So on the SPX, they're not big candles. They're like tiny little candles. And you're saying, well, where'd they go? That's because we're getting most of the move happening overnight. And during the day, the moves are kind of muted. And so that's part of the problem with doing 0 DTE. If you're looking for some movement, you have some, but not enough to really make a go of it with 0. So instead, you do a 1, 2, or 3 DTE, what we call a convexity stack or a sigma drift campaign. And then you can capture those bigger moves that happen overnight, like you're seeing here. Big moves. So that's the way that works. You just extend your DTE and your time horizon, and you can capture those bigger moves. But when you're trading intraday, it looks like, a nothing burger. That's exactly what's happening. All right, let's go back to the big head. That would be me. I'm clicking, but nothing's happening. There we go. All right. So we're about 35 wide. We're bullish. We're looking to bounce off the top of stairway number 2. And that's pretty much it for the 0 DTE trades. For convexity plays, we're looking at these what appear to be, and we don't know when they're going to happen. That's why we push them out. Currently, my convexity trades are out around 5 to 10 days because I just don't know when it's going to happen. But when it does, I'm going to reap those rewards. In the meantime, I'm taking tiny little risk, right? And I don't have to get whipsawed all over the place with this froth and this indecision and this insecurity with the Fed coming up. None of that affects me. I'm just waiting. I'm just going to sit back and wait for that big move. Just tell me when it's going to happen, and then when it comes, I'll reap the harvest. So there you go. That's the plan. If you're interested in trading, tail risk trading, then go down below and click on the Skool community. That's skool.com, Skool, skool.com/FatTail. because that's what we trade. We trade from 0 to 30 DTE. The 30 DTE trades are actually trades that we put on a little less frequently, and they're really meant for portfolio insurance. And so that's if we have this big existential risk, we putting on that insurance, and then it, the rest of our portfolio can go down, but then a couple of small trades totally keep it back where it was. Then we have all kinds of cash that we can pour into cheap assets. Yeah, that's how insurance works. In the meantime, we go for the shorter term, and we're taking none of the risk of these tiny, small trades, all the noise. We filter that out, and we're just waiting for convexity. And when those hit, we get big returns, and we're super happy with no anxiety. That's the whole deal. Plus, I should also mention the AI. The AI is unbelievable. It'll take you through cradle to grave in your trading, from the time you do analysis, enter the trade, manage the trade, leave the trade, log and journal, and then you do that, rinse, repeat. It takes you through that whole process. It's like having a coach right next to you, helping you make the decision, showing you the pluses and minuses of your decisions, and making you a better trader. And then at the end of the week, it looks at everything that you did, it piles it up into a retrospective, gives you all of your stats and everything. You see how you're doing, and then compare that to all the previous weeks, and you say, hey, I'm on the right path, man. Thank you very much, Mr. AI. And it will make you a better trader. That's what you get when you get into the FatTail Skool community. All right, that's about it. I want to thank you all very much. Happy Fed Day. Coach Ernie, out.